They have been lying to you, not with words, with numbers, with the comfortable fiction that the silver market is functioning normally, that your paper silver position is backed by real metal, that the price you see on your screen represents the true value of one of the most strategically critical metals on the face of this earth. And right now, in March of 2026, that fiction is colliding with physical reality, and physical reality is winning. I want you to stop whatever you are doing and understand what is happening inside the Comex, the commodity exchange in New York. Because what is unfolding inside those vaults right now is not a correction, not a hiccup, not a temporary disruption. It is the beginning of a systemic failure of one of the most important commodity pricing mechanisms in the entire global financial system. And if you are holding paper silver futures contracts, unallocated accounts, paper ETFs, silver certificates, you need to understand what that means for you personally right now. Let me start with the number that should be front page news in every financial publication on earth. In April of 2020, Comex registered silver, and I want to be precise here because this distinction is everything. Registered silver is the metal that is specifically designated ready and legally eligible for immediate physical delivery against futures contracts. It is the metal backing all those paper promises. In April 2020, that number stood at 240 million ounces. As of the end of February 2026, that number has collapsed to 86.13 million ounces. That is a 64% drain of the metal backing the entire Comex silver futures market in under 6 years. And it did not stop there. It is draining right now every single day at a rate of 785,000 ounces per day. The registered inventory is being pulled out of those vaults by institutions who no longer trust the promise of future delivery. They want their metal now. They are taking it now. And that pace of withdrawal is accelerating. Now, I want you to feel the weight of what happened in January of 2026, because January is historically one of the quietest months in silver delivery. In prior years, January typically saw somewhere between 1 and 5 million ounces of physical delivery. January 2026 delivered 49.4 million ounces of physical delivery. January 2026 delivered 49.4 million ounces. That is 7.27 times the level of January 2024. In a single week in January, 33.45 million ounces were physically withdrawn from Comex vaults. That is 26% of the entire registered inventory vanishing in 7 days, not rolling forward, not settling in cash, demanding the physical metal. And then February came. February is also historically a minor delivery month. In February 2026, Comex processed 5,036 contracts, 25.118 million ounces of physical silver, the highest February delivery volume in the entire recorded history of the exchange. On the very first notice day, January 29th, 881 contracts were immediately called for delivery. Industrial users were not waiting. They were not rolling forward. They were not doing what the futures market is theoretically designed for. They were demanding to receive their silver immediately because they knew something that most retail investors still have not figured out. The metal is disappearing from the exchange faster than it can be replaced. And then March arrived. March is Comex's primary delivery month, the major delivery month, the month when the paper promises are supposed to meet the physical reality. On first notice day for the March 2026 contract, February 26, delivery notices were issued for 10,526 contracts. February 26, delivery notices were issued for 10,526 contracts. That is 52.63 million ounces of silver being demanded for immediate physical delivery. At that moment, total registered Comex inventory stood at 86.13 million ounces. Do that math with me. 52.63 million ounces demanded in the first moment of the delivery cycle against 86.13 million ounces total available. That is 61% of the entire deliverable inventory being called at once before the delivery cycle had even properly begun. And the open interest backing the March contract at that point represented between 425 and 528 million ounces of notional paper exposure. If even 20% of those contracts stand for delivery, a number far below the delivery rates we saw in January and February, Comex would need to deliver between 85 and 106 million ounces. That is either at the absolute limit of or already exceeding what sits in those vaults. Veteran precious metals analysts are not mincing words. They are calling March 2026 potentially the funeral of Comex as a credible price discovery mechanism. But I want you to understand something much deeper than these individual delivery numbers, because those numbers are a symptom. The disease is something that has been building for 5 consecutive years, and it is rooted in a structural reality that no amount of paper printing can fix. The global silver market has been in deficit, meaning the world consumed more silver than it produced every single year since 2021. The Silver Institute, which is the authoritative global body tracking silver supply and demand, confirmed the 5th consecutive year of structural deficit in 2025. The cumulative shortfall over those 5 years is estimated between 820 million and 900 million ounces, nearly equivalent to 1 full year of total global silver mine production, gone, consumed, burned permanently into solar panels, embedded into circuit boards, pressed into the conductive paste of semiconductor chips, and incorporated into the electrical systems of electric vehicles that are never coming back. That silver is not sitting in a warehouse somewhere waiting to be recycled back into the market. It is gone, irreversibly consumed. And the deficit in 2025 alone, with global silver demand reaching an estimated 1.24 billion ounces against total supply of only around 1.01 billion ounces, represented a gap of more than 200 million ounces in a single year. Mine production is not coming to the rescue. Global silver mine output sits at approximately 813 to 830 million ounces per year and has remained essentially flat. There are no massive new silver mines being rapidly brought online. Silver is primarily a byproduct metal. More than 70% of global silver production comes as a secondary product of mining operations focused on copper, zinc, and lead. When those operations decide whether to expand, they are looking at copper prices and zinc economics, not silver prices. The silver market does not get to call for more supply the way an oil market might respond to a price spike by bringing new wells online. The response lag is measured in years, sometimes a decade, from exploration to production. The structural deficit is not going away next quarter. It is not going away next year. It is going to get worse. And here is why. The industrial demand consuming silver at this record rate is not speculative. It is not people buying silver coins hoping the price goes up. It is factories. It is solar panel manufacturers who require approximately 20 grams of silver for every photovoltaic unit to achieve the electrical conductivity that makes those panels function. China installed more solar panels in the first half of 2025 than the entire rest of the world combined. The European Union has mandated solar energy integration into new buildings starting in 2026. Saudi Arabia is constructing massive solar farms targeting 50% of domestic electricity from renewables by 2030. Every single one of those solar panels requires silver, and there is no economically viable substitute. Not copper, not aluminum, silver. The International Energy Agency estimates that by 2030, the solar and electric vehicle sectors alone will consume half of global annual silver mine output. Half. And that leaves the other half of mine production to supply all the semiconductor fabricators, all the AI data center builders, all the medical device manufacturers, all the smartphone producers, and all the millions of retail investors and central banks seeking silver as a monetary asset. The math does not work. The math has not worked for 5 consecutive years, and the math is getting worse every quarter. Electric vehicles are accelerating this consumption. Each EV uses 25 to 50 grams of silver in its electrical systems, sensors, wiring harnesses, power management modules, and braking systems. EV-related silver demand jumped an estimated 20% in 2025 as global EV sales continued their structural growth trajectory. Data centers are an emerging but rapidly growing demand vector, using silver in high-efficiency electrical components, precision contacts, and thermal management systems designed to handle extreme power loads that previous data center architectures never required. The semiconductor sector, the foundation of every advanced technology product on Earth, uses silver in bonding processes at the chip level, processes where silver's unique combination of electrical conductivity and thermal properties simply cannot be replicated by cheaper metals in advanced chip architectures. Industrial demand for silver is price inelastic. When a solar manufacturer's production line requires silver paste and the price doubles, the manufacturer pays double. Shutting down the production line costs more than the silver. The factories will pay whatever it costs. This is the defining characteristic of the silver crisis that makes it categorically different from every previous silver price event in history. Then China changed the equation permanently. On January 1, 2026, China implemented a new licensing framework for silver exports. And I want you to understand exactly what this means because the headline version does not capture the true significance. China dominates 60 to 70% of global silver refining capacity, not mine production refining capacity. Refined silver is what actually flows through global markets. Raw ore from a mine in Mexico or Peru must be refined before it becomes tradable silver, and China controls the industrial infrastructure that does that refining for the majority of the world's silver supply. Under the new framework, exporters of silver must obtain a government license from China's Ministry of Commerce. The license requires demonstrating a consistent export record between 2022 and 2024, proving annual production capacity of at least 80 tons and maintaining a credit line of $30 million. In December 2025, China released the approved whitelist. 44 companies, that is it. 44 firms through whom the entire Western industrial world must now negotiate access to Chinese refined silver for the next 2 years. China's state-run Securities Times explicitly stated that this policy formally elevates silver from an ordinary commodity to a strategic material, placing its export controls on the identical regulatory footing as rare earth elements. The Chinese government used the exact same playbook it used with rare earths, with tungsten, with antimony, a graduated strategic restriction designed to preserve domestic supply advantages while creating leverage over global competitors. If China reduces exports by 50% under this framework, analysts project additional annual global silver deficits exceeding 5,000 metric tons. The Western world has just been told that the silver spigot is now controlled by Beijing, and it has 44 approved keys to turn it. The market is already reflecting this fracture in a way that should alarm every silver investor. The Shanghai Premium tells the story with brutal clarity. While Comex was pricing March 2026 silver at one level, physical silver on the Shanghai market was trading at a 9.38 premium, a 12% spread above Western paper prices. In Japan, retail premiums on secondary silver markets surged to as high as 60% above spot at points of extreme demand. In early January 2026, a 1-ounce silver coin on the Dubai market was selling for $99.93, while the Comex March 2026 futures contract sat at $72 the same ounce. Nearly a $28 difference in price depending on whether you were buying real metal or a paper promise. This is not a temporary arbitrage that smart traders will close with a few cargo plane shipments. This is a structurally fragmented global silver market where physical metal commands a dramatically different price than paper promises, and the gap is widening, not narrowing. London is under equal pressure. The London Bullion Market Association, the LBMA, is the world's primary hub for over-the-counter physical silver trading. London silver lease rates, which under normal functioning conditions sit below 1%, spiked to 39% on October 9, 2025. Not 3.9%, 39%. This is what it costs to borrow silver for short-term delivery obligations in the most important physical silver market on Earth. Even after that spike moderated, rates remained at extraordinary levels, 7 to 8%, compared to the historical norm of below 1%. The LBMA's own free float of immediately available silver fell below critical thresholds. Multiple major Indian mutual funds, Tata, Kotak, SBI, UTI, temporarily suspended new silver fund subscriptions because they could not source sufficient LBMA-certified silver bars at any price. Bank of America became the first major bank to raise its 2026 silver forecast dramatically, citing persistent supply deficits and irreversible industrial demand. BNP Paribas suggested silver could reach $100 per ounce by end of 2026. Peel Hunt raised its full-year 2026 silver forecast by 79% in January. These are not fringe analysts in a newsletter. These are major financial institutions staring at the same data and drawing the same conclusion. Silver's futures curve has entered persistent backwardation. Let me explain precisely why this matters, because this is the most underreported technical signal in the entire precious metals complex right now. In a normal commodity market with adequate supply, future-dated contracts trade at a premium to the spot price. The premium covers storage costs and financing. The futures market says, we are confident the metal will be available later, and here is what it costs to hold it for you. When that relationship inverts, when the price of silver for immediate delivery today rises above the price for future delivery, it is called backwardation. And backwardation is the market confessing that it trusts a promise of future delivery less than it trusts metal in hand today. Silver's backwardation in early 2026 reached $2.88, the deepest backwardation since the 1980 Hunt Brothers crisis. Every contract through late 2026 was trading below the current spot price. This is not a quirk. This is the entire silver futures curve telling you physical scarcity is expected to persist for years. The market is not pricing in a temporary dislocation. It is pricing in a structural breakdown. And historically, when silver has entered backwardation at this depth, it has preceded major price re-ratings of 20 to 50% within 6 to 12 months, not because traders got excited, but because the physical reality forced the paper market to reprice toward truth. Now I want to bring this home to what it means for you as an investor in language that is absolutely clear. For decades, the system worked on one foundational assumption: not everyone would demand physical delivery at the same time. The ratio of paper silver promises to actual physical silver in exchange vaults reached as high as 356 to paper ounces claimed for every single physical ounce backing them. This system functioned because it was a confidence game. As long as everyone believed the metal would be there when they needed it, most of them never needed to find out whether it actually was. That confidence is now breaking. The delivery rates we are seeing, 98% physical delivery rates in February 2026, 7 times normal January delivery volumes, 61% of registered inventory demanded on the first notice day of March. These are not speculators. Speculators roll their contracts forward and take their cash profit or loss. The institutions and industrial users driving these delivery requests are saying something very specific. We do not trust that the metal will be available later at any price, so we are taking it now. That behavioral shift from trusting the paper system to demanding physical metal is the single most important development in the silver market in decades, and it is accelerating. Comex has tools available to it. In an extreme scenario, it can raise margins sharply, and it has. It can introduce cash-settled contract alternatives. It can, in an extreme case, suspend trading. We saw the London Metal Exchange suspend nickel trading in March 2022 when nickel prices rose 250% in 2 days, and the exchange controversially canceled billions of dollars in trades to protect short sellers from forced losses. The precedent exists. If Comex moves toward cash settlement for silver contracts, you will not receive silver. You will receive dollars at a price set by an exchange that has just admitted it cannot deliver the physical metal. And the real silver at that point will be trading at whatever the fractured physical market sets as its true price, which could be dramatically, historically higher than the cash settlement figure Comex announces. Your paper silver position would be settled at the paper price while the physical metal screams toward its real value. This is not a hypothetical. This is the documented risk of holding claims to silver rather than silver itself. I want to be precise about what I mean when I say physical silver, because not all silver investments carry the same risk profile. An allocated physically backed silver trust where your specific bars are segregated, titled in your name, stored in a vault outside the banking system, and not subject to any other entity's borrowing or lending, that is physical silver. A futures contract is not. An unallocated bullion bank account where you own silver in theory, but the bank can lend it, rehypothecate it, and use it in other transactions is not. A silver certificate of any kind that represents a claim on metal is not physical silver. It is a promise, and the crisis unfolding at Comex is a crisis of promises. There are too many promises and not enough metal. Silver price surged to an all-time high of $121.62 per ounce in January 2026, and even after margin-driven corrections, it remained above $80 levels that represent a fundamental repricing of the metal away from the paper market's long-suppressed valuations. Inflation-adjusted price targets, depending on the methodology, range from $150 to $250 per ounce. These are not sales pitches. These are the mathematical outputs of comparing historical purchasing power ratios with current structural deficit trajectories. The United States officially added silver to its critical minerals list in late 2025. China elevated it to a strategic material in January 2026. Two superpowers simultaneously have looked at the same metal and made the same declaration. Silver is no longer an ordinary commodity. It is a national security asset. When the two largest economies on Earth reach that identical conclusion at the same moment, the only rational response is to ask yourself why you are still treating your silver exposure as an ordinary financial investment. The Russian government announced a $535 million program to purchase precious metals over 3 years, led by Silver Sprott Physical Silver Trust, doubled its capital raise program to $2 billion in January 2026. ETF inflows to silver-backed funds reached nearly 150 million ounces in 2025 alone, and every ounce flowing into an allocated ETF vault is an ounce permanently removed from the exchange delivery pool. The people who understand this market at the institutional level are repositioning. They are not waiting for the crisis to be confirmed in mainstream headlines. By the time it is confirmed there, the silver will already be gone. The Comex registered inventory drainage rate stands at 785,000 ounces per day. The 5-year cumulative deficit has consumed between 820 and 900 million ounces of above-ground stockpiles that once served as the world's emergency buffer. China has locked the refining spigot behind a white list of 44 companies. The March 2026 delivery cycle represents the highest first notice day delivery pressure in exchange history. Backwardation has reached depths not seen since 1980. London lease rates spiked to 39%. Shanghai premiums hit 12% above Western paper prices. Japan retail premiums touch 60%. Industrial demand is mandatory, irreversible, and growing faster than any supply response can address. Mine production is structurally inelastic and will remain so for years. Every major financial institution that has looked at this data honestly has raised its silver price forecast dramatically. The Comex silver crisis has begun. The paper market is fracturing at the foundation. The only question that now matters, the only question that has ever mattered when a promise-based system meets physical scarcity, is whether you are holding a promise or whether you are holding the metal itself. The answer to that question determines everything about what comes next for you. Make sure you know the answer.